Welcome back. Today, we're cracking open the toolbox of the professional options trader. We're going to talk about something that sounds, I don't know, kind of like a secret society, but it's actually a crucial financial tool: the Greeks. So, yeah, let's just dive right in and figure out what all these mysterious letters are really about.
At its absolute core, options trading is all about dealing in possibilities. So the first, biggest question we have to tackle is this: how in the world do you put a price tag on something that might happen? Think about it. An options value isn't just about where a stock is today. It's about where it could possibly go tomorrow, or next week, or even next month.
So that price you pay for an option, what we call its premium, it's actually made up of two different things. It's part hard reality and part pure, unadulterated possibility. It's the value it has this very second, mixed with the value of everything it could become down the road.
Okay, let's put these two values side by side. On one hand, you've got intrinsic value. This is the real, tangible, hard cash value. It's super simple. If a stock is trading at $55 and you have a call option with a $50 strike price, well, it has $5 of real intrinsic value. Simple as that. But then you have time value, and this is where it gets interesting. This is the extra bit of money you pay for the chance, for the possibility that the stock could move even higher. And here is the most crucial part. This value is a depleting asset. It is constantly decaying, and when that option finally expires, the time value is gone. Poof. It's always zero.
Honestly, the best way to picture this in your head is to think of time value as a melting ice cube. The second you buy it, it starts to melt. Every moment that ticks by, a little bit of its value just vanishes into thin air, and you can never, ever get it back. This constant erosion, it's one of the most fundamental, powerful forces in the entire world of options. And here's the kicker. That ice cube doesn't melt at a nice steady pace. Oh no. Just look at these numbers. When you go from 90 days out to 60 days, you only lose about 18% of the time value. Not too bad, right? But now, look at that last 30 days. The value just falls off a cliff. It plummets. This acceleration, which traders call the hockey stick effect, is what catches so many new traders completely off guard. The closer you get to expiration, the faster that ice cube melts.
And yes, of course, we have a name for this rate of melting. It's Theta, our very first Greek. Theta tells you in dollars and cents exactly how much value your option is expected to lose every single day, just because the clock is ticking. So for an option buyer, Theta is this constant headwind you're always fighting against. But for an option seller, it's the wind at your back. It's a potential source of profit every single day.
So, if Theta is just one of these invisible forces acting on your trade, how do you manage all of them? Well, I want you to think about it like this. If trading options is like driving a high-performance car, then the Greeks are your dashboard. This is it. This is your dashboard. Delta is your speedometer, telling you how fast you're moving relative to the stock price. Gamma is your accelerator, telling you how quickly that speed can change. Vega is like a report on the road conditions ahead. Is it smooth sailing, or are things about to get bumpy? And Theta, as we just saw, is your fuel gauge, constantly, relentlessly, ticking down toward empty.
All right, let's take a closer look at what each one of these gauges on our new dashboard is actually telling us. First up, Delta, your speedometer. It's just a number, usually between 0 and 1 for calls. So, a delta of, say, 0.60 simply means that for every $1 move up in the stock's price, your options price is expected to go up by about 60 cents. It's your immediate, real-time exposure to the stock's direction.
Right next to it, you've got Gamma, the accelerator. Gamma tells you how much your speedometer, your delta, is going to change as the stock moves. A really high gamma means even a small move in the stock can cause your delta to ramp up or down very, very quickly. This is why it's sometimes called the risk of risk, and it's most powerful for options that are right at the money, where the outcome is the most uncertain.
And then there's Vega, a road conditions report. Vega measures how sensitive your options price is to changes in what we call implied volatility, which is basically the market's collective guess on how much a stock is going to swing around in the future. Think about the days before a big earnings report. Uncertainty is through the roof, right? Well, implied volatility rises and options with high Vega get way more expensive. Then, after the news is out, that uncertainty evaporates and all that extra value can just vanish in an instant.
So we've got this incredible dashboard giving us all these real-time risk readings. But where does it all come from? What's actually powering it? Let's take a quick peek at the seriously sophisticated engine running under the hood.
And here it is, the big reveal. The Greeks are not just clever nicknames somebody made up. As J. Robert Buchanan puts it, they are literally partial derivatives. They are the direct mathematical output of calculus, and they are precisely measuring the rates of change for all the different variables that can possibly affect an option's price.
Whoa. Okay, don't worry, you absolutely do not need to memorize this, but this is a simplified version of the famous Black-Scholes formula, one of the foundational engines of all of modern finance. Just appreciate for a second that this is the complex machinery that takes in all the inputs, stock price, time, volatility, and it spits out not only the option's price, but all of our dashboard gauges too. Your delta, gamma, vega, and theta all come from this. And you know what? This engine is constantly getting upgraded. The math has evolved way, way beyond those original models. Today, the quants, the quantitative analysts, they use these incredibly advanced forms of mathematics, like stochastic calculus, to model ever more complex market behavior. The science behind pricing possibility is just a deep, fascinating, and constantly evolving field.
Okay, that is enough theory. How does a real trader actually use this dashboard to drive their portfolio and make smart decisions out there in the real world?
Well, just by understanding theta, you can find two completely opposite trading philosophies. On one side, you have traders who want positive theta, so they sell options. Their entire goal is to have that ice cube melt in their favor, so they can collect that decaying premium as their profit. On the other side, you have traders who take on negative theta. They buy options, and their bet is that the stock is going to move so much and so fast that the gains they make will totally outrun the constant melting of that ice cube.
And this all leads to a really logical, repeatable workflow. First, you assess your risk. You check the dashboard. What's my directional exposure? How much am I losing to time every day? How would a big spike in volatility affect me? Second, you formulate a strategy based on those readings. And then, you execute. And most importantly, you continue to monitor those gauges as the market changes around you.
So let's just pull this all together. The Greeks are your dashboard for seeing and measuring risk. They let you quantify all those invisible forces that are constantly pushing and pulling on your trades. Just remember that time decay isn't a straight line. It accelerates like crazy near expiration, and that volatility is a huge factor you have to respect. At the end of the day, understanding this dashboard is what lets a trader go from just guessing and hoping to making truly informed strategic decisions.
And that kind of leaves us with a final question to chew on. If you have these incredibly precise tools, born from some of the most advanced math there is, tools that can measure every single facet of an option's risk, does that transform trading into a pure science, or does it just give the artist a much more sophisticated set of brushes to paint with? Something to think about.